And Peter, I want to welcome you to our second Trader Summit. You did such a great job on the first one, and I'm really looking forward to catching up with you. So much has happened. For those of you that don't know Peter, and I don't think there are many, Peter is known for this saying that the Fed is not data dependent, they're S&P dependent. Also, last interview with Peter, he proposed that maybe the market's going to be okay and peaks on a vaccine. So, the market was and heading up. It held 3,200 this week. Who knows if we're going to, if that was it for the correction. I kind of think we're going to have a rally to 3,400, one more shoe to drop, but I know some bulls that think that was it. And, up and away into the election and a Trump victory. So it's going to be very interesting times. So, Peter, welcome back to our Trader Summit. It's really nice to have you.
Thanks, Dale. Great to be here.
Okay, so, Peter, you publish this book report, and it's not the kind of book report that as kids we would tell our teacher that the dog ate it, or I dropped it and the wind blew it away. It's filled with your outlooks for what's happening in the economy. And I want to start off with the Fed. So I can't remember a time that we've been hearing from the Fed chair, Jay Powell, more frequently. I know it used to be Humphrey Hawkins' day, but it seems like Fed speak is all over the place. And have you heard him since his tenure began, kind of sounding hat in hand that we really need some fiscal help? It's the first time I've heard Fed chairman really pushing for Congress to do something. It almost makes it seem like the Fed can't do it all on its own. Is that the message he's trying to get out there, to put some political pressure on them?
Well, it's a message and it's an acknowledgement on his part that the Fed can't stimulate economic growth anymore. They've expended. Now they can always do more, but doing more of the same thing doesn't generate growth anyway. So they've expended their ability to stimulate. And I argue the policies of the Fed right now are actually restrictive. So one of the things, and that's why Powell keeps deflecting towards the fiscal side, because I think he acknowledges that. So this is why I argue why people should not be looking at Fed easing or zero rates or QE as accommodation and stimulative. And this is why. Let's take forward guidance, which Powell in the last press conference used powerful multiple times when referring to policy and referring to forward guidance, meaning that they're not going to raise rates for 3 years. Okay. So
Yeah.
the whole point of stimulus is to stimulate you to do something now instead of waiting till tomorrow or next week or next month. So by telling us that rates are going to stay low for 3 years doesn't stimulate you to do anything. You can just sit and wait. It doesn't create any sense of urgency for you to behave now. So it doesn't stimulate. It actually is a drag. Then you take what is happening to the banking sector. So if you're a big company
Oh,
in the US, you have access to the capital markets. You don't need to call your banker at JP Morgan and say, price out a loan for me out 3 years. I want to do this project. But if you're a small, medium-sized business, you do rely on the banks. You do rely on your local banker to extend that loan to you. But look what's happening to the profitability of the banks because they've lost the yield curve. A lot of
right.
banks lend on LIBOR plus. Well, LIBOR is at the floor with rates at zero. So the spreads on lending LIBOR plus are very much squeezed. So that small, medium-sized bank that doesn't have a capital markets business is getting squeezed. Therefore, they're going to limit their loans to small, medium-sized businesses. So policy is restrictive, and BOJ policy has been restrictive for years. ECB policy has been restrictive for years. So it shouldn't be a mystery as to why this type of policy is not generating faster growth and the inflation that delusionally these central bankers inevitably want.
Okay, so in the real economy, it's restrictive. In asset classes, it continues to add fuel to higher prices. What we're talking about, a lot of people are using different letters, K recovery, V, W. What letter does it look like to you? It's mainly been lower class people that are still really in a lot of pain. Is this about to filter up to white collar workers and people that really have been untouched in a lot of major recessions that we've had before? And because they own stocks, because they own real estate, the asset markets, those assets have bailed them out and kept them wealthy. Plus, their jobs were not in danger.
So I'm going to take a little bit of a contrarian viewpoint here, and it's going to tie into something that we discussed last time. Is in that I'm actually confident that at the end of October, early November, the vaccine news from Pfizer is going to be positive. And while the world, and particularly most of the people in the US, are not going to get vaccinated if they choose to get vaccinated until next year, I think that if that is the case, you're going to see this huge shift, at least in the markets, and I'll distill that to the economy, from
Okay.
the obsession of what they bought over the last 6 months, Zoom stock,
Right.
and all
Stay at
FANG,
home.
and all the stay at home, and
Yeah.
that all the areas of the market that had been left for dead, airlines, hotels, restaurants, concert halls, all that, you get positive news. And if I'm right now, we all hope that we get positive news, but let's just say it actually happens, which then is the precursor to a part of the population that starts to get inoculated at the end of the year, and then a mass rollout in 2021. Well, just imagine those stocks are going to roar, and they're going to sell off this whole work from home. Like, I'm of the belief that memories are short, that human nature is human nature, and that we're going to want to go back as best as possible, as close to possible, to what our lives were like before. That means going back into the office. That means going out for dinner, going to a movie, going to a sporting event, and so on. So what I think is going to happen is this is, I think, a decent possibility. But the implications are the 10-year yield is not going to be 65 basis points. You're going to see
Okay.
the world's bond market, upon a workable vaccine, will be a sale of the century. And not just in the US, but all over the world, because it was the virus that got us into this mess. And it's going to be a vaccine that gets us out of it. But it would then handcuff the world's central banks. Inflation is going to follow. I mean, we already have, in my opinion, I am on this in the inflation camp story here. And we can get into that conversation in a bit.
Okay.
But this is why I think while what can be good for the economy in us getting our lives back to normal again, even though it'll be in fits and starts,
Right.
it could be real trouble for parts of the financial markets, and a positive for other parts of the financial markets.
Peter, just to interject here, we had Mark Yusko yesterday in a very interesting interview. He actually has the opposite view, having to do with how much life can go back to what it was. And we're not talking about leisure, like if we're going to go back to the restaurants, if we're going to go back to movie theaters. Once it's safe, there is no question about it. People will, restore their lives having to do with leisure and the rest of the activities back to what it was. His point was that on a business environment, things are going to change, mainly for a couple of reasons. One of them is because a lot of businesses are finding out that there was a lot of fat that they could actually cut out. And the second one is because being forced to go out of the norms, they find out that there are methods, quite effective methods, to do things with a lot less expenses.
Oh, I agree with Mark. When I talk about things going back, I'm talking about the way we live our lives in terms of actual business. I mean, and even consumer spending behavior. I mean, savings rates. What we've learned from a personal standpoint and from a business standpoint over the last 6 months is the importance of saving for a rainy day.
Yeah.
And all you have to do is look at these airline companies that have been going hat in hand to the U.S. government to bail them out when they all spent billions and billions of dollars buying back stock over the last bunch of years. If there was an industry that needed to save for a rainy day, it was the U.S. airline industry. So
Yes.
yeah, I agree with Mark, who I have huge respect for, that there will be, this has been a traumatic effect, a traumatic impact of the last 6 months. There is going to be generational changes of behavior. There's no question about it. And it's going to be with respect to how companies treat their balance sheet, how they spend their money, how they buy back stock, how they invest in their business. And from a consumer standpoint, yes, I think savings rates will continue to remain elevated. So yeah, from that standpoint, there will be a change in behavior. I was really more referring to just our day-to-day lives sort of reverting back. But from a balance sheet standpoint, from how we operate our personal P&L and the business P&L, yes, that will change again, because this saving for a rainy day mentality, staying efficient, and the world's supply chains and the way we deal with inventory, yeah, things will change. I'm not saying, my point was not to say it just goes back to the way it was. I meant more personal behavior goes back. So maybe that restaurant
absolutely
will be 100% open, so we can bring those people back to work. But yeah, there's always going to be a change in behavior, but I think it's just going to be more on the margin rather than anything else.
So perhaps, Peter, right now air travel, I don't know, maybe they have 20%, 30% passengers on planes. Are they loading up planes now? And if they're not, everyone will feel safe enough to travel. That'll bring the airlines back, in your opinion?
Yeah, so right now, I think it's very important that everyone watches what is happening in China right now, okay? The Chinese movie theaters are about 90% back to the way they were. Chinese travel within the country, and we heard from Trip.com on Friday, which, with full disclosure, I own the stock, that the domestic travel industry and business in China is almost back to the way it was. Now, transatlantic and multinational travel is obviously been impacted because every country's got their own quarantines
right.
But looking at China, just from a behavior
domestic
standpoint, tells you that we are going to go back to as close as possible life we lived, and a vaccine will help us do that. So use what's happening there as a template, because we like watching movies here just as they like watching it in China. So you can get a vaccine, those movie theaters are going to be filled up again. Those concert halls are going to be filled up again rather quickly.
And the sectors that will suffer are going to be interest rate sensitive. So housing's been on fire, making new highs. Not just the shares are, and home prices are making new highs, and they talk about lack of supply. So we're going to have a shift from businesses and shares that have benefited from low rates when yields begin to rise. Could you see yields getting back to, say, 10-year back to 2-3% in this type of scenario?
So I would say 2, 3.
Okay.
I think the Fed may fight that tooth and nail, but 2
Okay.
definitely. And I'll go on to my inflation theme. We already have a lot of tinder right now for inflation, and this is not necessarily because of the Fed. This is sort of almost in spite of the Fed, just looking at pure supply demand. So when we look at inflation, we obviously have goods prices and we have services prices. Now, for years, we've had services inflation running at about 3% because of higher rents, higher medical care costs, higher insurance premiums, and so on and so on. That was offset by a compression in the prices of goods. So now medical care costs will remain very steady, 4 to 5%, unfortunately, per annum that we've been seeing. Rents should soften a bit as we're dealing with COVID here, but I'm hoping that obviously if I'm right in the vaccine, that rental prices really aren't going to fall that much. So then it leaves the good side. So what we've had is an upheaval in global supply chains. And that has led to right now, and I'll go through some examples, fits of major capacity constraints. On the demand side, because of all this fiscal spending, we've been able to refill consumer pockets to a level higher than where they were before, and that these government transfer payments more than offset the lost wages and salaries. So
Still, hasn't that diminished?
Well, yeah, it softened in August, obviously, without the extension. But going into that, we had retail sales that were above where they were in February. It was quite extraordinary. But Washington is all ready to spend another $1.5 trillion plus, which I think they'll end up doing. So part of those coffers will get refilled again. So we've had elevated demand relative to where it would have been otherwise. We've had these major supply constraints that have already led to a pickup in the inflation numbers. And then if you do get this workable vaccine, you're going to get an even greater pickup in demand that the supply side is just not going to be able to keep up with. So if I'm the CEO of United Airlines, and we get and right now I furloughed thousands of pilots, tens of thousands of flight attendants and other workers, and I got a bunch of planes sitting in hangars everywhere, I'm not just going to be able to snap my finger and bring all this back. It's going to take me many, many months to sort of recalibrate my business to where the growing demand will be. So you're going to have a supply-demand imbalance there. A lot of these airlines, the passenger airlines, took a lot of cargo. People don't know that. They figured, well, they take the person and their piece of luggage, but there's a lot of cargo that was taken. Well, we've taken all these airlines offline, and FedEx and UPS all of a sudden is getting flooded with business, and they announced that they are announcing surcharges on every single package that they're going to deliver this holiday season. Remember, we had basically 2 months where the world was shut down, 2 months of not making anything. So there's a lot of catch-up that needs to take place right now. We have a lot of inventory building that's taking place, and that's why manufacturing has been pretty steady. Durable goods orders are steady, not because there's this great end demand, but because we need to refill inventories, or we need to rebuild these shelves after being shut down for a couple of months.
Okay, so isn't there a hole left from the shutdown? I know that we could get back to close to normal, but during the times when we were shut in, that was all lost revenue. Okay, lost revenue to the states, lost revenue to businesses. And even though you're beginning again to get your revenue back to more normalized levels, what about that gap of lost revenue, lost gains, opportunity costs, and how about the people that are 5-6 months behind on their rent, and unless the government does something, if I've seen stats that in most states, Peter, up to a third of renters would not be able to pay their rent if the moratorium on evictions were not intact anymore. Let alone also homeowners with, they have the ability to postpone their mortgage payment, and that's going to end in March. What kind of shape is that going to leave the consumer in when their housing situation is going to be pretty uncertain and a lot of supply come onto the market?
There's no question that this is going to be, a multi-year process of recovery. I mean, there are businesses that are not coming back. There are restaurants that are not coming back. There are balance sheets that are going to obviously need to be repaired in a major way. So this is going to take a lot of time. But to my point on inflation, and it's going to lead to higher interest rates, and that's going to create its own problem. Now, it'll be good. Maybe we'll get some steepness in the yield curve. Maybe the banks will get a lifeline. It'll certainly be good, I believe, for the whole commodity space that is going to have a nice rebound. But high PE stocks, over-levered balance sheets, high yield, these are the industries that could have trouble. So there's going to be major upheaval in certain areas, and could be lights at the end of the tunnel with others. I think in the aggregate, we're not going back to 3.5% unemployment anytime soon. We're not going back to this everything is great anytime soon, but I think that it'll be a shift in today's mentality. I mean, today's mentality is work from home, and this virus is here forever, and rates will never go up, and
Right.
you just keep on buying these tech stocks, and everything will be fine. And the point I'm trying to make is that I think people should need to start shifting their attention that the next 6 months even could be much different than the last 6 months. And certainly the next couple of years are going to be very different than the last couple of years. And I also think from, I mentioned China and how they've, at least from the virus perspective, have sort of gotten their shit together and are trying to, from the average person resuming life again, that is going to happen also all throughout Asia. I mean, they were much better, most of these countries, at
Yes.
dealing with this virus and making mask wearing part of one's wardrobe, and locking down for a week and then reining things in and then reopening. And so the entire Asian region is going to be on a higher growth trajectory than the rest of the world. And I know all of China's problems and the debt and this and that, but it's the Chinese consumer that's going to drive their economy from here on out. And the rest of Asia that has dealt with this much better, that's an area of the world that's going to see growth, that's going to see more normalization a lot quicker than us. And I think from an investing standpoint, that's another area that people need to be looking at.
Do you see any impact of higher yields on the fate of the U.S. dollar?
Yes. So just out of a textbook, higher inflation is negative for your currency. Now,
Right.
of course, there's inflation throughout the world on this, particularly in Europe. You can argue that it will be negative for them as well. But the things that the dollar have going against it from a big picture standpoint, outside of so the secular negatives for the dollar versus the cyclical reasons why the dollar can have its rallies. I mean, the big secular negatives, obviously, major trade and current account deficits, meaning there's more dollars going out than coming in. You have the exploding U.S. debts and deficits. You can draw a chart over the past 20 to 30 years of the dollar index and the U.S. budget deficit as a percent of GDP, and now that percentage is 15%.
Yeah.
Now it should come in if the economy does rebound next year, but that is literally off the charts. So the secular story, the secular negative for the dollar is clear. I think the bullish case for the dollar the past 6 months was this dollar shortage argument.
Yeah.
And I get it, and then I've heard it a million times. But if a dollar shortage gets us, if this was the dollar rally you get from a dollar shortage, well, there's not a shortage of dollars anymore that I see in a major way that would result in the currency rallying in a sustainable way. So I think we're seeing the major flaws in the dollar this year, and also, the world was turned upside down, and what kind of rally did the dollar have? Well, not much, especially when you compare it to the dollar rally that we saw in 08, 09, when the world's financial system was falling apart. That was a dollar rally. This dollar rally was pretty lame, and this is even with all the holes to that these other countries and other currencies have. That this is the best the dollar can do.
Okay.
If I may interject,
go ahead,
Dale. Peter, you mentioned the exploding deficits and debt, which, as you very well said, if we plot them, it was more than clear that even pre-COVID, there was a clear path to escalation of the problem. So the question is, what makes us think that they can come back to normal even in a post-COVID world? Since the US economy was clearly debt dependent and in an increasing way on a yearly basis. And second of all, do you think there is a threshold, and where would you put that after which the market loses its faith in the ability of the US to repay its debts at some point, and so the dollar?
Well, so to your point, and I've said this before, is that we don't have economic cycles anymore. We have credit cycles that ebb and flow with Fed monetary policy. Yes, we are a credit-dependent society and economy, and the world has turned into that, and are much less dependent on savings, which the Federal Reserve and other central banks have obviously dissuaded by scaring you out of bank accounts and scaring companies from holding cash. And we have more triple B companies than we've ever had. We have less A plus credit rated companies that we've ever had. So yeah, we're not going to have that same credit driven buoyancy in economic growth that we've had before. So that's why when I talk about getting back to normal, it's getting back to normal in our lifestyles, not necessarily getting back to the same growth trajectory that we had before. And that may be the new norm with US growth, because we can't rely on credit to the same extent as maybe 1.5% type GDP growth to 2% tops, rather than this 2 to 3. So it is, yes, a recalibration in the pace of growth, because that credit impetus has met the law of diminishing returns. And we know it takes more and more debt to generate that same level of GDP, which means, yes, in the aggregate, less economic growth until you deal with this debt, either through inflating it away, writing it down, paying it off, or sort of growing your way into a more sustainable debt to GDP type ratio.
And which of those things you think is more likely to happen?
Well, it's going to be a combination. It's going to be debt write-ups, because there's going to be more bankruptcies, particularly if we get, if I'm right on a vaccine, inflation, and higher long end rates, that there's going to be there are going to be companies that are just not going to be able to refinance, and not, the low rates have created a lot of zombie companies. Well, you get a rise in interest rates, and you kill off some of these zombies. So it's going to be certainly a change in growth rates, and there's a lot to plow through here. But in terms of the markets, when you look at some leisure and hospitality stocks that are down 50%, I mean, one area that I'm actually warming up to are the UK pub stocks. JD Wetherspoon, you have Young Brewery. These stocks have been cut in half. Now, deservingly so. I mean, they're restaurants and they're pubs, so obviously less people going. But if there is a V bottom, like a barber shop is a V bottom, right? When the lockdowns ended, people needed to get their hair cut. And you can show me any GDP growth rate you want, or any economic statistic, people are going to go back to getting their hair cut every 3, 4, 5 weeks. So I think that people are going to want to go back out for dinner again, and they're going to want to have a pint of beer. So that is one area that's going to have a V bottom. Now, there are other things that are just not. There are other things that are going to take more time for people to get comfortable with, even with the vaccine. And then dealing with all this debt, and dealing with central banks that are going to have to start. I mean, what's the Fed going to do? The Fed has, I'm going to keep rates at 0 for 3 years. But the reason why rates are at 0 is because of the pandemic. You take away COVID and it's gone. What's the Fed going to do? They're going to sit there and think like, oh my God, how can I keep rates here at 0? They're going to have to start pivoting, because if they don't, then the long end of the bond market's going to do it for them.
A counter argument to that.
The 10-year yield is going to be 2 to 3%, tightening in the face of the Fed.
A counter argument to that, though, is that the Fed started cutting rates pre-COVID, when we actually had that seizure in the repo
in the
market.
fall. Yes.
Yeah. So, I mean, I'm not really sure if, yes, COVID, of course, accelerated everything and made everything implode. There's no question about it. But I'm not sure that we wouldn't be near 0, even if we didn't have COVID, at least with seeing what was happening the months prior to the problem.
But Steve, to what Dale said earlier, what I said is the Fed is S&P 500 dependent.
Yeah, absolutely.
Okay? The Fed pulled back after they saw what happened to the stock market in the fourth quarter of 2018.
Yeah.
Correct.
They realized that, oh shit, we overdid it here. And then Powell got all scared. And then, but also keep in mind, he started cutting because of the China trade war and the tariffs. That's why he started cutting he stopped raising because of the stock market. And then he started cutting because he felt like he needed to offset the negative impact from these tariffs, which I hate to this day, these tariffs. That's why he did what he did. So it was, if we didn't have the trade war, that really started to amp up in the summer 2018, and that's when the world's manufacturing base peaked out, then he wouldn't have been cutting in 2019.
Okay, Peter, I want to ask you, you know, a lot of people talk about the biggest bubble this time is in the corporate bond market. You brought up the example of the airlines borrowing money in the corporate bond market to buy back stock, creating a margin account for them. Are they going to be good shorts as well as a high yield of the bond sectors here in the US? Because I know you like some bond markets overseas and emerging markets. Would the junk bond market and the corporate bond market be on your radar for a pretty big hit and possible opportunities on the short side?
Sure. Well, the greatest, yeah, the greatest bubble is in credit generally, particularly on the sovereign side with all the negative yielding. I mean, negative yielding bond is the epitome of bubble because it's the ultimate hot potato, because that asset is actually a liability, and you have to hand that liability off as quickly as possible to somebody else, hopefully at less of a hit. So you take the airline industry, which is loaded up on debt to survive. Now, the airline industry, the airline business will come back, but these companies, I don't know what the equity value is going to be. I mean, I think American Airlines, their debt level is going to be approaching $40 billion. I wouldn't want to be an equity holder of United Airlines. I'd rather be a debt holder if their business comes back. So their balance sheets that are going to be beyond repair, but it'll be the equity holder that first gets hit. And if I'm wrong, I mean, everything gets, if I'm wrong and Pfizer doesn't have good news next month, and there is not, and the side, now there'll be positive benefits to whatever with this vaccine, because there are going to be people that have antibody responses and immune responses. The thing with the vaccine is they need to limit, obviously, the side effects. If we reach a point where there are too many side effects for too many people, even though you may help a lot more people, that's where we have an issue with a workable vaccine that's mass used. That's the risk to my thesis, of course. But there are a lot of balance sheets that, even with an economy that bounces back, are still going to be beyond repair. And it's going to be the equity guys in certain industries and certain companies that are going to get clipped the most. And even recovery rates for bondholders are going to be much less than where they were before. I mean, I know, like, you take like senior loans, you know, like these business development companies that issue a lot of they buy a lot of bank loans, and the bullish cases, well, these are senior secured, so they're safe. Well, that used to be the case when you had subordinated debt below that, where they would get hit first before the senior guys. Well, the problem now is that a lot of that senior stuff, there's nothing below it. So they go after the senior guys immediately. And yeah, maybe it's secured by something, but it could be very possible that that asset that's securing it has been impaired as well. So any recovery rates are going to be less than they were in the past. And so I think it's going to be interest rates that are going to be kryptonite for central bank policy, because it freezes them from easing anymore, and they're going to have to start thinking about tightening. The market's going to tighten for them, and there's going to be some positives, but there are going to be some certain a lot of messes. There's going to be a rethink on PE ratios. I mean, the mentality that we're back in for areas of technology where it's okay to pay 30, 40, 50 times revenue.
Yeah.
There's going to be a rethink if all of a sudden the 10-year yield's at 1.5 and 2 and 2.5 and 3, and we're printing monthly CPI core numbers of 3, 4, 0.5%, which I think is where we're potentially heading. And again, exaggerated if we do get a vaccine. And to the point we had in our last conversation, that how ironic would it be for the stock market to bottom on a full shutdown and top out with a vaccine.
Okay, so you talk about these yields, and I want to acknowledge past couple of years you've been very constructive on the precious metal arena. I'll quote you after silver had a little bit of a move. You said it had a long runway. The runway took it to about $27. Gold over 2,000. We're in the pullback area here. Are you getting excited about it, or would it be possible if we're going to start seeing higher yields that there'll be some competition, since there was zero competition with no opportunity cost for holding gold with rates where they are? What do you think is going to be the impact of rates on precious metals?
So we have to narrow our focus on precious metals to watching two things: the dollar and real rates. And pay attention to nothing else. Don't pay
Okay.
attention to geopolitics or the world is falling apart, I need to own gold. Focus on those two things. So I think the secular bear story in the dollar is firmly intact.
Okay.
And to the point you just made is, yes, interest rates may rise in the long end, but that rise will be slower than the rise in inflation.
Okay.
Therefore, real yields will take another leg down. In the 1970s, and I'm not going to compare double-digit inflation, double-digit interest rates and say that's where we're headed here, but
Yeah.
real rates were negative 4 to 5%. We are negative maybe by 1% now. So there is a ways to go in terms of negative real rates if I am right on inflation. So that's what you have to pay attention to. So if core CPI goes from 1.5 to 3,
Right.
I don't care if the 10-year yield goes from 65 basis
two.
points to 2, because real
Right.
rates are still firmly negative. And inflation is going to go to 3 well before the 10-year goes to 2, because the Fed's going to do what they can, at least verbally, to try to slow that rate of gain in the long end, whether it's through more QE or yield curve control, even though the irony is that they're sort of rooting for it by wanting higher inflation.
Okay, so we're getting close to the big day, the election. I'm interested in your views of the election.
Dale,
And yes,
before the elections, one question.
sure.
Are you sure they're rooting for it, Peter? I mean, are you sure that, yeah, they seem to be rooting for it. Are we sure they're actually rooting for it? Or perhaps they're afraid that this time they will actually manage to stimulate it. So
Okay.
they want to appear like that's what
Like
they want. So when it happens, they
they have
don't
cover.
need, yeah, they have cover and they don't need to act like, they're in distress and they have to do something about it. Because I've heard both opinions.
Well, let me start by saying that there is no economic model that tells you that if inflation is higher, growth is faster.
I agree.
It doesn't exist.
I agree.
The reason why the Fed theoretically wants an inflation rate of 2% is not because it's good for the economy. It's because they think it's good for their policy. Because in their mind is, if inflation is at 2, over time, that means the Fed funds rate will be at least 2 to 3 to 4. Therefore, if the Fed funds rate is 2 to 3 to 4, that means that they have rates to cut in a downturn. So the Fed is saying if we can get inflation back up sustainably, well, then that will allow us to raise rates to a certain level that we then can use to then cut in the next downturn.
They need that to normalize.
Economics. It's idiocy beyond belief, because the way to avoid that is to never cut rates to 0 anyway. There's no economic lift if rates are at 0 relative to 1%. I can argue that growth will be faster with the Fed fund rates at 1 relative to 0, and what I said earlier on in this interview.
I agree 100% with you.
So that's how you avoid that situation. So that's how the Fed thinks about this. Because actually, in reality, if the inflation rate goes higher, it shrinks real wages, it damages those that can least afford it, and it's actually an economic depressant.
Exactly. But the question still is: do you believe they want it, or you believe? I mean, do you believe they can achieve it, or they're just hoping for it?
So central bankers, before they actually step into the building, they may have some independent thought. When they step into the building, they all become robots, and they all drink this econometric Kool-Aid of historical central bank policy. So you listen to Jay Powell today versus when he actually was just a Fed governor, and you look at the transcripts of the critique he had of QE and so on. And we actually thought he'd be this different central banker. And wow, he was a private equity guy and he would think differently. He is just the same old as Yellen and Bernanke and Draghi and Kuroda. He is absolutely no different. So they actually believe the nonsense that they say. Now, there are some independent thinkers like Esther George and even Robert Kaplan. And so there are some, and Richard Fisher prior to Kaplan, that they don't necessarily drink the same stuff. But there still is this group think about, well, if inflation's 2, therefore growth is good, and it allows us to sort of deal with the debt and everything will be fine. But, inflation targeting is not like a video game where you're playing asteroids and you can shoot and you can hit these meteors and you can knock them out and you can get to a point by pressing these buttons. I mean, that's what central bankers become, these mad scientists, that if they press these econometric buttons, that somehow we're magically going to get to these objectives that they've been shooting for. Even though we've seen over the last decade around the world and past that in Japan that none of this works, but they still have this mentality that they just seem to not be able to shake. And you know what the problem is no one challenges them because they live in a bubble. Because when Powell speaks, he's doing it in front of Congress and he gets nonsense questions from Congress people. And then he speaks at his press conferences and none of the reporters challenge him in any way. So he never get a chance to be challenged by people like us. And they enter this bubble, and that bubble really inhibits their ability to think outside the box.
To your point, your friend
Danielle,
Mrs. DiMartino yesterday was telling us that they believed, from what they knew, that Powell was, very
going to
different
be a
in
hawk.
his way of thinking. He's going to be a hawk, and we all see what happened. I mean,
when the market cracked, he's saying "Kumbaya" with everyone.
Yeah,
right. Didn't he go through a conversion where he had to drink the Kool-Aid after the market tanked?
Well, one thing I told people is, you may think that about Powell, but remember, Powell voted to keep interest rates at 0 for 7 years and voted for all the QE. So if you're going to vote for that, you're really no different than everybody else.
Absolutely.
Yeah.
Absolutely.
So I guess you were before you were getting to the election.
Yeah, go ahead, Peter.
So there are obviously a few things, and putting aside the politics. I mean, look at this simply. Trump wins. Republicans keep the Senate. It's as is. There's going to be no major legislation in terms of tax policy. That'll stay the same, and no major change on the regulatory side. And people will just have to deal with Trump's personality. And if you hate him, you hate him. If you like him, you like him. But from an economic standpoint, a market standpoint, at least initially, things may not change. The inflation story, I think, is still going to happen because Washington is spending money hand over fist. And all the inflation pressures that I see happening are still going to happen regardless of who's president. So we're still going to get, in my opinion, of trouble in the bond market. We're still going to have trouble in high PE stocks. And if I'm right in the vaccine, we're going to have rally in the stocks that are down 50 to 75% on the pandemic. If Biden wins, but the Republicans keep the Senate, well, Biden will use his executive orders and alter the regulatory regime again, as Democrats will be running these agencies. But from a tax policy legislation, obviously not much is going to change. And then if Biden wins and they take the Senate, which is likely the case where whoever is the president will probably take the Senate, well, then you're going to have, at least the last 2 months of the year, you're going to have a big sell-off in stocks because no one's going to want to have to pay a higher capital gains tax rate in 2021. They're going to lock in the 2020 rate. everyone's going to then start cutting S&P earnings estimates because they're going to assume the corporate tax rate is going to be 28 instead of 21. And then you're going to have all the regulatory squeeze on a variety of industries. So in November, December of this year, if that were to happen, every investor is going to shoot first and aim later. Then in 2021, then we'll see, okay, what is a Democratic-controlled Washington actually going to want to do in terms of tax policy? Because if the economy is still troubled, well, maybe they're not going to want to raise taxes until 2022. When Obama came in January 2009, well, he actually extended most of the Bush tax cuts that expired because he didn't want to be presiding over big tax increases in the middle of a recession, even though we were about to come out of it. So even the tax-loving Democrats, they may even wait a year until the economy gets on firmer footing. So there are a lot of different dynamics here on where we can go. There's going to be a big difference. Is Lau Brainerd going to be Treasury Secretary if Biden wins, or is it going to be Elizabeth Warren? Well, we know there are differences there, even though Brainerd is obviously a Democrat as well. So there are definitely nuances to all this, but I think it's clear what the markets will do November, December. If Trump wins, it'll be okay. If Biden wins and the Democrats take the Senate, you will have a bumpy 2 months in the markets.
Okay, we have another option. What if nobody wins and it's contested and it ends up being a court battle or social unrest, which has been pretty intense before this election? I don't think either side is really going to take it well. And there are too many guns in America. Anyway, so what do you think can happen during that pause of us not knowing for who knows how long?
So there is definitely a greater than 50% chance that we do get that contested election. And my ex-boss, Larry Lindsay, thinks the odds are about 80% that we have a contested election. And we won't know who the president is that night.
Right.
But we will know at some point, because a major factor in the contestation, if that's even a word, of states, because it'll come down to 5 or 6 close states where the loser will fight it and say, you know what, I am not conceding the state until every mail-in ballot is counted. So we have a lot of states that says you can send in your mail-in ballot up until election day, that as long as it's postmarked November 3rd, that is a valid vote. Well, we know you go to the post office on November 3rd, that's a Tuesday, assume it's received on that Friday or Saturday, it's probably not being opened until the following Monday or Tuesday, and it's going to take time to actually count them. So I think eventually, within 2 to 3 weeks, we're going to be able to count these votes, and we're going to know who the president is. So yes, it's going to be contested. It's going to be a mess for 2 to 4 weeks, but I still think we're going to get to an end game, and we are going to know who the president is. Now, there'll be less of an issue if who takes the Senate is clear that night. Now, we can have certain Senate races that are contested, no question about it. But if we know if the Republicans take the Senate on election night, then from a market perspective, even if Biden wins, they know the limits of what he'll be able to do.
Great
and if
point.
Trump wins, well, it'll be status quo. If the Democrats take the Senate, and we know that on election night, then, of course, what happens in the next 2 to 4 weeks obviously takes even greater importance.
Peter, when you speak, you create interest in the topics that you talk about. And I had a question from one of our attendees, Mr. Boockvar. Can you recommend a book for learning about monetary policy, interest rates, bond yields, inflation, and how all those interrelate?
That's a great question.
You're going to have to write a book, Peter.
Yeah, I will give a shout out to my close friend Danielle, who wrote an amazing book called Fed Up.
Okay.
That is a great education and sort of behind the scenes inside baseball on the behavior of the Federal Reserve. So I would read that. In terms of bond books, I used to work with, and I'm still friends with Tony Crescenzi, works at PIMCO. I would
Yes.
Google his name, and he's written some great books on bonds and interest rates, and you'd find that very helpful. I'd read some writings on Jeremy Grantham over the past 20 years, who has a couple of different experiences of calling out central bank policy, and find that is very helpful. The writings of Jim Grant. Jim Grant is a great prophet on writing about interest rates and Federal Reserve policy. And I think if you stuck to that, at least for now, you'd get quite an education.
And subscribe to the book report.
Yes, exactly. Correct.
All right, Peter, you got a pleasure having you. Thank you for coming in and edifying. Really a great interview, and
thanks for having me.
A lot of conviction. We appreciate you being here,
Thank you.
And we appreciate you, Peter Boockvar. Everybody.
Thanks so much.